Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. And it is Friday, April 12th. So this is our Investment Friday episode for the week. I'm here with the Chief Investment Officer of Juncture Wealth Strategies, Brad Haines. How you doing, Brad?
I'm doing great. How are you?
I'm good. And we've got some guests, your Frenchies in the background today. If anyone's watching on YouTube, you might see some cameos from, what are their names?
Tank and Gracie.
Tank and Gracie, the Frenchies. So
Yeah, I apologize. They're very excited sometimes, and other times they're asleep. So,
you know
that's the way
what?
Frenchies go.
They're totally fine. So yeah, if anyone needs a YouTube diversion, you can go look on YouTube and watch the Frenchies in the background. Anyway, so we have had a little bit of an interesting week. This week it's felt a little bit crazy as far as the market swings have gone. And so tell us a little bit of what's been happening with that, Brad.
Yeah, so I think everything got kicked off. First of all, to put this in context, we've had the last 6 months has been very, very low volatility, good returns. We had the market rally start broadening out, a lot more stocks participating. So a lot of clients felt good about what their portfolio was doing and still is doing well. It's just we've started to see a little more volatility come into the market. What kicked it off this time was a CPI report that came in higher than it was expected. Now, not much higher than expected, but it still was higher than expected. So this was the third month in a row that people were getting very concerned about, or people were getting concerned that now this is a trend. This is no longer just a one-off. This was, wow, inflation is being resurgence. And because the labor market is still so tight, people are very, very concerned that inflation can come back if the Federal Reserve lowers interest rates too quickly or too early. And so this is a very, very large fear. Historically, this happened in the 70s. We had a Federal Reserve chairman named Arthur Burns, and Arthur Burns had conquered, if you will, the first wave of inflation in the early 70s and started to actually lower interest rates once he thought that inflation was back into a manageable sphere. And unfortunately, those lower interest rates, coupled with a supply crunch with the oil craze or the oil embargo, really jumped up inflation to the second wave, which extended that peaked far beyond the first inflation wave's peak. And so that is when Paul Volcker came in, raised interest rates very aggressively, very quickly. And that's where everybody has the stories from, oh my gosh, my first mortgage was 12 to 15%,
Right.
and I don't think we're going to get there, but that is the fear. And so that fear fed into the equity markets this week with people starting to sell off some of their equities, just thinking that, well, if the Federal Reserve isn't going to lower interest rates, then the S&P 500, the equity market in general, may not earn as much money as it was expected. And so that's correcting that over optimism, if you will.
And so, well, when we're looking at inflation from this perspective, is we've talked about this on the podcast before as well, that when interest rates are high, so when we can get a high yield savings account or a money market account that's earning 4.5 to 5+%, sometimes even 5.5% on a money market account, people evaluate their stocks much differently. right? Like it's okay if interest rates are going to be high and inflation isn't necessarily going down and we're not going to see interest rates going down anytime soon, I, feel safer pulling the money out and putting it straight into a money market instead. So instead of something that might fluctuate more, I'm just going to put it in something that feels like safe. If I know if I put my money into a high yield savings, it's going to be there and earn 5%, right? Is that a piece of it?
Yes, that's correct. That's correct. Um, that's exactly right. Um, yeah, it's an interesting dynamic with um inflation and the turnabout, because inflation, generally speaking, is also very healthy for corporations and companies that have pricing power, right? And that at the end of the day is what it is signaling, is companies have pricing power. And for the United States, we haven't had companies having pricing power for a very, very long time. They've been able to pass along small increases over long periods of time, as opposed to since 2020, they've been able to pass along large ones very quickly, which is the problem. Um, and now what's happening is you have the labor costs and other costs that are catching up. So it is still helping out from a margin standpoint. But right now, as we're disinflating a little bit, that is constraining, that's starting to hem in their margins a little bit. So it can be a little problematic, that balance between higher prices for your goods you're selling or services you're selling, and the labor costs and your input costs, as to how much you have to pay those. So that's why it's really beneficial to the margin early on, but then it starts to hem in those margins pretty tightly, um, later on in the inflation cycle.
So it's really interesting that you are mentioning this because one of the things that I've been following, and I do a lot actually. I spend I spend time listening to people and reading stories about the experience that kind of the 95% are having in America, right? So the top 1%, the top 5% of income earners are in a good spot right now, right? Like there
Yes.
nothing, nothing feels out of reach for some portion of the population. And on the other side, again, this other, about 95%, we are seeing a lot of like actual tangible evidence of people having a harder time in this economy, whether that be finding a job or getting a raise that meets inflation, um, renting something, renting a house or buying a house, right? Like has become really difficult for a lot of people. And this piece of companies, corporations having taken the opportunity in 2020, 2021 to raise prices substantially, right? That okay, it was more than what was warranted is what it's like the message that's coming out at this point in 2024, right?
Yeah.
That the way that corporations increased prices through, that time, yes, there were supply issues in some areas. Yes, there were some things that made, you know, some goods and services hard to obtain, but that wasn't everything. And that there was a much more widespread price increasing or price gouging, if you want to call it that, happening through that time. And now, so to see it coming through, what you're saying here is like, oh, well, we had all the goods inflation over that time. So now people need to make more money because you inflated the goods. And now you're having to pay more money to your workers who literally are the ones producing the goods because they
Yes,
need
that's
more money to live because
yeah,
you
that's
inflated
exactly
pricing.
right. Yeah, that's exactly right. I mean, early on in an inflation cycle, it's very beneficial to for most businesses, it's very beneficial. For example, if you have goods inflation because oil's going up, right? Um, it gives other businesses a little bit more room to go up a little bit. So if I was a retail gasoline purveyor or convenience store that sold gasoline, and oil was going up a lot and it was all over the news. Can I raise it one more penny a gallon beyond what my price normally would be, including the inflation? So then that's how it bolsters margins early on. Later on, what happens is consumers can't really afford that extra penny. So what happens is it starts to what we consider destroy demand. So all of a sudden people start to carpool. They start to look at electric vehicles more seriously. They start to just cut down the number of miles driven. So then the demand for gasoline goes down. And that happens generally. And so it's later on in the cycle that becomes problematic. And that's where we are today. We have high costs and we have disinflation in most areas.
And so that's like the super interesting part that I think we wanted to talk about more today too, right? Is that some area we are seeing some disinflation in some sectors. But what's interesting about the inflation numbers just in general, and I've always, since I've been in the industry, right? So for 18 years at this point, I have always been a little bit mystified that a lot of the core CPI figures don't include gas, housing, food, right? These like the things that again humans pay for. And that actually like take up most of our budget for most people, right? Like your housing, your groceries, and then yeah, your transportation in America, right? Everyone needs transportation, or most of us do. So it's very interesting to be looking at these numbers and see, okay, well there has been some, again, disinflation, inflation numbers coming down from what they have been with some goods, but then we've got housing and auto insurance actually was another interesting one that you mentioned that are very high, like higher than, the other core CPI or consumer price index averages that have been reported. So let's talk about the auto insurance one real quick, because
Okay.
that's an interesting one.
Yeah, so it's home and auto insurance as well. So both insurances, the function they provide in a society is why we purchase them and pay premiums for years, even though most of us don't have claims every year on either one of those.
And you're not supposed to, or else you get in trouble.
Right.
You get
Or they
dropped from your
drop.
insurance.
Yeah. So it's that, hey, we're going to replace whatever is damaged or whatever, we're going to step in at a point where you have a catastrophic loss and we're going to provide for that. That's the general principle. Well, with the value of whatever is insured goes up, then that cost goes up, that cost of insurance, if you will. And so insurance companies, both on the auto policies and home policies, have really ramped up their premiums over the past few years to reflect higher values. Used auto prices have come up substantially since 2020. Home prices have exploded since 2020. And so those insurance costs are now starting to catch up with those higher valuations, because the insurance companies are realizing through their experience that we probably haven't collected enough premium to protect ourselves against catastrophic losses. So it's something that people need to be very, very aware of, that inflation has shifted a little bit. Excuse me. From goods to services, and part of those services, for the most part, are still disinflating, but yet there are some areas in there that are coming up. And in this report earlier this week, it was, oil prices auto and home insurances, and shelter inflation. Shelter inflation is an interesting dynamic because it is disinflating, but from a very, very high level.
Mhm.
And it's a very large proportion of both the consumer price index, which is the CPI, but also of the PCE, which is the personal consumptions index, which is, or personal consumption expenditures index, which is the Federal Reserve's preferred measure of inflation, because the CPI only takes an average of urban consumers. The PCE takes everybody into consideration in the United States.
Mm.
Now, there's flaws to both. And part of those flaws is that they average things. So shelter inflation, based on the value of those homes, is still very, very high, very sticky, because they average it. It's right now, it's taking about 10 months from 10 months of shelter inflation to flow through to the CPI. So that
Mm.
this week, when they announced inflation, that shelter inflation component reflects conditions 10 months ago.
Wow.
Okay. So, some of the research uh, that I follow and that I've done, shelter inflation right now tracks very, very closely something we call the new tenant rent index, which is what it says. New tenants signing leases. Where are those lease terms in terms of prices? Where are they compared to a year ago? Are they higher? Are they lower? By how much? Um, as of right now, that new rent index is -4%. So what that means is the people signing leases today are getting it less expensive, 4% less expensive than they would have a year ago.
Mm.
All right. So it's actually deflation. However, the CPI this week said shelter inflation was roughly around 6 to 7%. So again, down from a very, very high level, still coming down, but yet still very, very sticky, very, very elevated relative to history. And so if you take the new rent index, or excuse me, you take the CPI and you advance it 10 months, it tracks the new tenant rent index very closely. And like I said, new rent index right now is -4%. It's showing that new renters are deflating. Those new rental terms are actually going down. So while people are very, very excited, it's caused some volatility in the marketplace. If we want to set oil aside for a second, most things on the PCE and CPI will continue the disinflation for the remainder of the year in our expectation.
Interesting. So yes, that's saying, and I'm understanding this better. We talked about this a little before we started recording, but it's clicking a little bit better at this moment. That so this is forecasting then that from today, April 12th of 2024, looking at January, February of next year, that could mean we actually see deflation,
On the
not just
shelter,
on shelter, not
on
just
shelter.
disinflation.
Yep, absolutely.
Hmm.
So while everybody is getting a little concerned about, hey, is this the last 3 months CPI data? Is that going to give the Federal Reserve's Open Market Committee, is that going to give them enough evidence to delay or to just cancel interest rate decreases? And it could delay it, is my expectation. Is the second half of the year is when they will start to possibly lower interest rates. They're starting to run into a weird time frame though, where can they do it right before the election without seemingly trying to help one party versus the other?
Mm.
There is some perception issues that they may just withstand, they just may not move around that time frame, prior, let's say September, October timeframe, they won't do anything because of the early November election.
Mm-hmm.
And then they'll move in December. So that is I don't know, that is a possibility, because they want to continue to assert their independence. They want to show to the marketplace that, hey, we're not being influenced by political desires, by policies. We are doing it based on solely upon our dual mandates of keep keep everybody employed and keep inflation down to our target of 2%. Now, what's interesting is one of the data points that I follow is a aggregation of 13 million different price points throughout the country. And it's a company called Trueflation. It's a big data company, and their data engineers go in, they grab all this data, they clean it, and then they produce an aggregate index of what inflation as of right now for the average US consumer is. And right now they're at 1.74% as of today.
Mm.
So they don't do any averaging, they don't do any of that stuff. So again, can it look a little skewy sometimes? Right now, it's indicating it's actually lower than the target rate, the Federal Reserve's target rate of 2%. And that's where I think we will end up. The CPI and the PCE are always a little bit more elevated or lower. They're more stable, I should say, less
Mm.
volatile than the Trueflation measure, because they do those averagings and because of the way it's constructed. So do we get the PCE and CPI in the 2 to 2.5% range here in the next 10 months? My guess is yes.
Hmm. Interesting. And then at that point, especially within the next 10 months, right? Again, we're talking into 2025 at this
Right.
point, where um if it's hanging out around there, which is the target rate, are we going to see interest rate decreases at that point either? Right? If the
Yeah.
Fed is like, if it's sticking around at 2%, the Fed doesn't necessarily have a reason to lower rates.
Yes, because we right now it's restrictive policy. Okay. Um, Even though the market has adjusted to make it a little more loose over the past couple of months, um, it's still restrictive policy. So what'll happen is they will lower interest rates, but how much do they need to lower?
Mhm.
Is it 1% in total? Is it 2%? I just want to remind viewers and listeners that having interest rates at 0% is abnormal, and
Right.
it's actually very unhealthy. It's actually an indication that something's broken in the economy. And so when people are analyzing, hey, this new mortgage rate, they're looking at the mortgage rates. Um, I wouldn't wait for 2 to 3% to get a mortgage. I just wouldn't do that because I think that's abnormally low, and I think that's indicative of something broken.
Mm.
Um, so if you can get 5%, that may be the new low in
Yeah.
that area. Now, I'm just forecasting out a little bit. So whether it's 4.5% or 5%, don't keep me with that because this is a couple years away. But I would encourage people to not necessarily have recent history as a guide to where they think mortgage rates will fall.
Or where they quote unquote should be, maybe, right? Like
Correct.
that's kind of the thing that's been really interesting and kind of dovetails into our final topic that we're going to talk about here a little bit today is housing prices.
Yes.
Right. And so that shelter inflation has been much higher. Like we were talking about shelter inflation being what does it cost to house yourself and your family? Um, and does that include both purchasing and renting in the shelter inflation? Oh my gosh. I mean, the balloons. on Zoom. I've got to get rid of that.
Hey,
I, I need to
it's a
look. I
nice
need to
little
look at my
surprise.
settings, right? Look at my settings. Stop on Zoom and I put my two fingers up and there's balloons, or I put my thumbs up and get the thumbs up, all that. Anyway, um, but so shelter inflation, does that in those numbers, does that include both purchasing a home and renting?
Um, no, it includes rent. It includes the cost of housing. So it includes rents. It includes what they call owner equivalent rent.
Mm,
So it's effectively how much could you rent your home for if you, instead of living in it, you rented it. Okay.
okay. Which
So
you can kind
there's
of see
some,
on Zillow too, right? Like,
yeah, yeah. I mean, there's a lot of assumptions that go into that number, which is why it's always a little I mean, it is what they do, but it can be a little squonky. And like I said, it's average. So, 10 months delayed, um, it can seem a little unrealistic in today's current environment sometimes. Um, but there's a lot of good reasons why they do the averaging. And so up until now, that has been the best tool set.
mm,
Um, but with big data, I believe that the inflation process, specifically with shelter inflation, will become improved at some point. Um, but it basically includes those measures.
okay. So the other so with that, the aspect that we actually wanted to hone in on today was we talked about this a little bit a couple of weeks ago, and I still would like to explore, like go more in depth on this as well. Maybe in another future episode if people want to hear more about it. But the private equity purchasing of single family homes. And in 2023 in particular. So this has been happening for quite a while. It's not new necessarily, but what is new is the rate at which private equity is buying single family homes. And so in 2023, the statistic that we saw, right, was that 44% of all single family home sales in 2023 were purchased by private equity.
Yes. And I think everybody who has in the past few years um, tried to purchase a home, there's always these, hey, they got another offer, it's all cash. And
Over asking.
they're outbidding you a little bit. And so they went with that offer. That is a very common occurrence nowadays. Whereas 20 years ago, that was a very rare event to have
Well,
happen.
and it's not just on, like a fixer upper home, right? Where you're
No,
like, this home is $60,000 and we're going to flip it, right? Like that totally makes sense. Someone can, put cash down for something like that. But we're talking like homes that are 500,000, $700,000, like big home
nice
purchases.
homes. Yeah.
Yeah, nice homes that are being purchased for cash by private equity firms.
Right.
And this piece of shelter inflation, it's really interesting how this is actually like it's part of the feedback loop, right? Because again, 44%. So what did we say before about like if private equity wasn't purchasing homes, what would have happened?
Right. That's where people have been flummoxed by higher yields or higher mortgage rates, substantially higher, from basically 2.25% to over 7%.
Mhm.
That has not really translated into lower single family home prices. I mean, they have in certain areas and on certain margins, but for the most part, home prices have been very resilient in the face of 5% higher financing cost via the mortgage arm. So
Mhm.
why? Well, it's because essentially half of the purchases are coming from cash. They're coming from uh, private equity and real estate investment trusts that are coming in and purchasing these homes and outbidding, households, and they're doing it for all cash. It is, in my opinion, it is uh, it is obscuring what would actually happen in the real estate market.
Mm.
And it's a feedback loop in the sense that as private equity gets more cash from institutional investors, they need to redeploy it. And part of the places they're redeploying it is in single family homes and then renting those homes out. So that can be a real problem for the neighbors because private equity does not care about who they rent it to. They only care about how much they rent for. And so, I've told you before, I had a personal experience, lived in a $700,000 home in Phoenix area. Private equity had purchased one of the neighboring homes and rezoned it as Section 8. For those who are unaware of what Section 8 is, it's essentially low income subsidized housing. So here they are, they have a $700,000 home that private equity purchased, and yet they're zoning it for low income. So what happens is in low income, the state of Arizona then is responsible for the rent and for any of the repairs after the renters move out.
Hmm.
So what happens is they're charging quite a bit of rent. So these are not inexpensive rentals. So what happens is you have families cohabitating in these homes. So you have 3, 4, 5 families get together, rent these homes. So on a per family basis, it's much less. Usually they're related and they're paying it and oftentimes they well, in my experience with the home in my neighborhood, no one took care of it because they knew the state was responsible for paying for the repairs after they moved out. And so they took a fairly nice home and we saw this happen 3 times in a very quiet, very nice, very very nice neighborhood. It really, really weighed on the neighborhood in terms uh of the lifestyle. So it's an interesting dynamic. I think private equity is has caused to a certain extent the lack of affordability for people that want to enter the home market, whether it's a starter home or that next step up. I think that they have really kind of obscured the market in terms of that because of the way they're investing the funds.
Yeah, it's so interesting to think about that because if they're, if they're purchasing outright, right, coming in with cash, that is, like you said, it's not just supporting, it's actually inflating the cost to buy a home. But on the other side, when we have interest rates that are as high as they are, um, people have been waiting or people have been, not able to purchase the same level of home that they would have if interest rates were at 3%. Right. So if you have an interest rate at 3% versus a mortgage interest rate at 7%, the amount of house that you can qualify for is going to drop dramatically, right? Where at 3%, maybe your income could have qualified you for a $700,000 house, which in some markets, Phoenix area, California, Colorado, so many areas right now, like $600,000 to $700,000 is actually like a 4-bedroom house, right? If you
Yeah,
need a little bit.
they're not super nice. No.
No, it's kind of like an average, again, 4-bedroom, 2-bathroom house, right? And you're going to pay $600,000 to $700,000 for this home that maybe, 10 years ago you might have paid 250 or 3.
Yeah, that's
Right.
exactly right.
Like that's what's happened in these markets. And so let's say that that's what you're looking to purchase, something you need: 4-bedroom house, 2 bathrooms, maybe you want, 2,400 square feet, nothing extravagant really. And you can't actually qualify for a $700,000 house based on your income because interest rates are so high. At 7%, you can't qualify for that. So then you're looking, right? And like, okay, well, what else is there? What is there in, okay, I can qualify for 450 instead. All
Right.
right, great. Now it's, all 2 and 3 bedroom homes
Yeah.
that
Or
I,
you're moving further out.
or you're
You're
moving, yeah, way far out
yeah.
from the centralized areas. Um, and your commute's going to be much longer. All of those factors that we kind of look at, as individuals when we are looking to purchase a home versus private equity, which is just coming in and saying, I don't care. I don't care who lives here. It doesn't matter. I'm not going to have, they're not going to have a loan. They're not paying 7% because they're coming in with investor cash. And like you said, then also not supporting the community that they are buying in either. Like I think that's the big the main harm almost. Maybe not the main, but it's like a pretty big pillar of like
Well,
what's going wrong with private
right.
equity.
So I live in Utah. I work in Arizona, and I have friends all across the country. And this experience of a dearth of starter homes that are affordable is everywhere. It's not just in one. It used to be just in California, New York, New Jersey, um, certain larger cities, and it's not that way anymore. It is across the board everywhere. Um, and and the reason why is because we've allowed institutional investors like private equity, real estate investment trusts to buy these single family residences. They were not involved earlier, and they are in a big way now. And so what do you do about that? Well, good luck, because it has to be the government that has to make rules and saying in certain neighborhoods it has to be owner occupied,
Mhm.
or something like that, where it can't be an institution buying a home. It has to be a family. That's the only way. The problem with doing that is the home prices would correct in a pretty big way for certain locations. So, it's do the politicians have enough willpower to do that, to see? So it's a mess, um, with a lot of unintended consequences. So I'm just glad I'm not a politician, is what I'm saying.
You don't have to worry about that side of it. Yes. No,
No.
I agree. I agree there, that it's more than it's going to take a different solution because we can't see, or I don't believe that if we see more private equity buying homes, if in 2024 it's 50% and in 2025 it's 60%, right? That we're again creating a problem that individuals cannot get their way out of,
Right.
right? It has to actually come from a policy standpoint. And you're right. If the on the one side, you're like, well, yeah, if I want to or if I want to sell my home now, I bought it for, I'll use literally my home as an example. We bought it for 292.5, I think. And at this point, we could probably sell it for somewhere in the 425 range.
Right.
Not too many years after. I mean, it's only been less than 6 years.
Yeah.
And we're not even in, like, I'm in Cincinnati area. I'm not in one of those super high cost um, of living areas. But, what individuals are experiencing is private equity coming in and saying, I'll give you, so we listed at 425. We'll give you 475 cash.
Yep.
And
Within
so,
30 days.
right. Yeah. Yeah. Like cash, no inspection, nothing.
Yep. We'll take it
And
as is.
as is. And it's a hard choice for individuals to make. And so and that's kind of the other, again, the piece that I'm seeing as I pay attention to stories I see and hear that, we can make a choice that no, we are only going to sell to a family. We are not entertaining cash offers because we know a family is not going to come in with $475,000 of cash and slap it down on a home because it's not a wise financial decision for a family. It just isn't for 99% of cases. And we can make that individual choice, but if our neighbor takes the private equity deal, right? Like it's not something that we can necessarily have a quote unquote moral choice around and fix.
No, in fact, I would not blame my neighbor if they did that,
Right.
because they got to take care of their family. That's the highest offer. Great. I mean, that is where the system's broken a little bit, because it's really the major problem of it is uh who invests in private equity are wealthy individuals and institutions. That's it. That's it. Everyone else does not invest in private equity. Private equity has very unique properties. You have to qualify with a certain level of income and or net worth to be qualified to buy into those, because they are very risky, and they're illiquid. They're 10 plus years of, you're not seeing any of your money back for 10 plus years. So they're very long term. There's very unique properties about them, which is why only the wealthy, only high income, only sophisticated investors get into those. Okay. So I'm not advocating everybody have the ability to get into private equity. That is not what I'm saying.
Nope.
It's that way for a reason. But having those individuals and institutions fund purchasing of starter homes and the next level up homes is what is driving, to a certain extent, a lot of the price appreciation in those homes across the country. I mean, 45 to 50% of the single family residences were purchased by quote unquote wealthier individuals and institutions. So you have this widening impact on creating a rental class, a class of individuals and families and households who cannot afford to buy a new home. Well, what do? They're going to rent forever. And as everybody knows or should know, that a tenant is stuck with whatever the rents are giving to them.
Right.
Whether they move out of one rental place or another, generally rents are going to be fairly close to each other within a certain geographical area. So they're beholden to the landlord saying, hey, you need to do 5% more this year than you did last year. Okay. That's the risk. And so 10 years down the road, they're paying substantially more. Now, as we've seen, rents are coming down. Okay. There's a lot of multifamily properties that are coming out as available over the next few years as these projects get done nationally, but specifically in certain areas. And that higher supply will moderate those new rents. And we've started to see that with the new tenant rent index coming down 4%. However, that's not, that can be very different per locale. So it's just something that people need to keep in mind. There's nothing really to be done other than, I think the government's going to have to put in some regulations to do something different that way, or create a new model where families start going in together, creating, and you have the older generation funding the younger generation to a certain extent. So there could be new models of ownership that come out that we haven't seen before that mimic the private equity type structure, but for families or very, very, very tight groups of individuals. So
Mm.
again, it'll be interesting to see how that morphs. But right now, part of the dislocations in the starter home private real estate or personal real estate is the private equity. It's a problem.
Yeah. Interesting. Well, it's something that we're going to continue to see, continue to uh, follow. I know it's, it's something that's on my heart and on my mind, just to pay attention to, how our money systems flow and work or not work for different parts of our population. Um, here in America, especially, but even globally, right? Like we're a global community at this point, um, in a lot of ways. And so, yeah, we'll keep talking about it. If anyone has any questions or thoughts that they would like to share with regards to any of this private equity, I also would like to talk about private equity purchasing um, home service businesses. That's another one that's been really interesting and kind of catching my attention lately about what does that mean and what's happening in those industries, because that's all a part of it. That's all a part of how, again, how our economy works, and how it works or again doesn't work for the actual humans that are here working.
Agreed. I think it's again, we were talking before, the home services business, whether it's electricians or plumbers or handyman services, um, that's a very difficult one, I think, to aggregate and follow the typical private equity model,
Right.
where you aggregate everything, you strip out employees,
All the inefficiencies.
the quote unquote inefficiencies, which is essentially laying off people that do the admin and the bookkeeping and the like. Um, it's a very difficult because all of them at this point require high human involvement. You have to have employees do the job right now. You
Mhm.
have to have, so it's an interesting, but yet I think very far out in the future, the ability for an investor to come in, strip out the inefficiencies, and to continue to grow without adding employees or adding that cost. It'll be interesting to see what kind of model that happens. Eventually, it will happen, whether it's through drones or through robots that help. I don't know. It could be a lot of different ways, but it'll be interesting to see how that transforms.
Yeah. We'll be watching it and we'll be talking about it here on the podcast. So thank you, Brad, for being here on Fridays. We are going to have a couple of weeks off. So I just want to mention that now. Next week, I'll be flying. Brad was flying for a couple of weeks. I'll be flying next week. And then the week after that, my family is taking our first family vacation to Disney World. I've never been there. I've been to Disneyland many times. I'm from Arizona girl. I'm from Arizona. Um, but we've never been to Disney World, and our kids who are 13, 11, and almost 9 have never been either. So everyone pray and wish me luck.
Absolutely. Just really, really good walking shoes.
Lots, yes, new walking shoes. Everyone's gonna have, new bathing suits, right? We're gonna take care of all the stuff. But yeah, so we're not gonna have an investment Friday episode for a couple of weeks, just so everyone's aware. But that gives you plenty of time to send in any thoughts or questions that you'd like for us to talk about on the podcast. So thank you so much, Brad, for being here. If anyone wants to send me a note, they can get me at Hannah, Hannah, at expansiveceo.com. And Brad, how can people get you?
They can email me at bhaines, BHAINES, at juncturewealth.com. Please put in the subject line podcast.
Yes, it's much easier to see, filter
Yeah. Yes.
all the
I
emails that come in.
We get a lot of emails per day, and so sometimes we will miss them if you don't put podcasts. So
Perfect. Well, thank you so much. And we will see you next time.
thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.